Decisions for a business is how to structure its long-term finances. This is the financing decision. In the previous few chapters, we've looked at the cost of different types of finance. Clearly, this is going to have an influence on how much of which sort of finance you decide to use, whether it's debt, equity, preference shares, or whatever. In this chapter, we're going to look at a range of practical and theoretical issues that need to be taken into account when deciding on how to structure your long-term finance. This is a very important chapter, but it's equally important that you can apply the practical points that we're going to make at the start of the chapter as it is that you understand the theory. Both areas are very important for you to get your head around. So in section 1 we're going to look at practical reasons for using debt and practical problems with using debt. Starting off with some of the advantages. There are 5 important reasons for using debt finance that we cover in the notes, and these can be remembered as DEBTS, debts. In reality, there are many other points you could make as well, and like all of the little frameworks that we create in these notes, you shouldn't restrict yourself to only discussing these points if you can think of other relevant points in the exam. But let's work through these 5 practical reasons for using debt. First of all, debt acts as a discipline on management. If you use debt finance, then you have to manage working capital properly. If you're only using equity, you never quite have that urgency. So debt, some debt at least, can create good financial discipline. If you use debt instead of a rights issue, as we saw in chapter 3, it can make your earnings per share look better. And that can result in a higher share price. But you have to be a little bit careful here, because if you take on too much debt, your price to earnings ratio can go down, and that might mean that your share price does not go up if you use debt finance. Debt can also be used to manage the risk of overseas investments. We're going to talk about this more in a later chapter. But basically, if you invest overseas, you create assets, perhaps in dollars. If you've got assets in dollars, you're exposed to the risk that the dollar devalues. But if you funded some of that investment with a dollar loan, it reduces your net assets in dollars, and as a result, it reduces your risk. Debt attracts tax relief. The more debt you use, the less your taxable profit, so the less corporation tax you pay. So you could use debt finance to benefit your shareholders by using the debt to fund your investments, and then using the lower tax payments to create bigger dividend payments for your shareholders. We'll look at that one again later in the chapter. Finally, debt can sometimes be a signal of confidence. In 2003, BP, the oil firm, announced that they were going to invest in Mexico and Russia. The investment was massive, it was 20 billion. And they announced a 5-year plan to invest in Mexico and Russia, and they were going to fund that investment with debt. And at that particular time, investors took that as a signal that BP must be really confident in these investments. Otherwise, they wouldn't be prepared to use debt finance. But you've got to be slightly careful with that point, because in the current financial environment, if you took out a lot of debt, your shareholders would probably get worried. And banks, especially in the current environment, wouldn't be prepared to just lend to a company if the shareholders were putting no money in themselves. We'll look at some more practical advantages of debt in a moment. Now moving on to look at some of the problems. The first practical problem that we're going to look at is that if you use a lot of debt and then there's a downturn in business, then you still have to pay the interest. And that might lead to a dramatic cut in the funds available to pay a dividend. This is sometimes called financial risk. And we can illustrate financial risk by using lecture example 1. In this lecture example, we're given a company's latest financial forecast and last year's actuals. And the requirement is to look at what's forecast to happen to profits before interest and tax as a percentage change, and what's forecast to happen to ordinary dividends as a percent change, and to explain the difference. I'd like you to pause the presentation here and have a go at the lecture example, and then review the solution. Okay, well, we can see that profits have fallen before interest and tax by 6,000 million, and the ordinary dividends have fallen by 1377 million. So to work out the percent changes, starting with profits before interest and tax, comparing against last year when profits were 12,000, we've seen a fall of 6,000. That's a fall of 50%. And similarly for dividends, last year dividends were at 2,000, they've fallen by 1377. As a percentage, that's 69%. So we can see that ordinary dividends have fallen much more dramatically than profits, and this is a good illustration of financial risk. And the reason that it's happening is because as profits fall, we've still got to pay the interest, and we've still got to pay the preference dividends. And that creates a fixed cost base, a financial fixed cost base, that makes dividends quite volatile. So ordinary dividends are falling by more than profits because interest and preference dividends still have to be paid. So the example has shown that debt creates high variability in dividends. We can also think of some other practical disadvantages of debt finance. Debt finance can create financial distress costs. Typically, if you use too much debt, your credit rating can get worse, and this can trigger a number of problems. Sometimes the interest rate that you pay on a loan is linked to a credit rating, so if your credit rating gets worse, then automatically you'll pay more on your existing loans. If you take out a loan, it increases the risk that the company is unable to pay the interest. Well, whenever you go into liquidation, there'll be high administration costs to pay. As your credit rating gets worse, you can also experience indirect financial distress costs. Customers start to panic about your stability and stop buying from you. Sometimes suppliers will think that perhaps you won't be able to pay their invoices, and so they start to charge you more to make it worthwhile to take the risk of doing business with you. Sometimes a business will have to sell stock at distress cost to raise cash to pay the interest. And sometimes your managers will start to change their behaviour. As you take on more debt finance, they start to get concerned about capital expenditure and become much more risk averse. So a business might stop investing if it takes on too much debt. Now this term, financial distress costs, as we'll see later, is a very important one, and you need to be able to go into the exam being able to give 2 or 3 relevant examples of how financial distress costs might affect a company. So we can summarise some of these practical advantages and disadvantages as follows. The sensible level of gearing for a company in reality will be affected by whether it's young or whether it's old, its life cycle. Most new growing businesses will have many investment opportunities, but will find it difficult to forecast their cash flows over the next few months or years. So although you want to invest, high levels of gearing, high levels of debt would not be wise, and you would be more likely to rely more on equity funding. Secondly, you might be a business with high levels of fixed cost. So if you're an airline, you might have quite high contribution because that's sales revenue less variable costs, and your variable costs of operating are quite low. An airline may well have high contribution and low profits because profits are calculated after fixed costs. So you can measure the level of fixed costs that your business has by calculating operational gearing. And if you are a high fixed cost business, then you're already quite risky. If an airline goes into a downturn, its revenue will go away quickly, but its fixed cost base will remain stable, and you can be making dramatic losses very quickly. So in that situation, taking on more fixed cost by using debt finance is risky. Some businesses operate in sectors where technology is constantly changing. So what's selling well this year may well not sell at all next year. And if you're in that sort of dynamic business environment, you can't forecast your cash flows. And then if you've borrowed a lot, you're taking a big risk. Finally, it's not practical, sensible to recommend the use of debt finance if a business is unable to offer security. So if you don't have tangible assets with a ready market value, then you're unlikely to be able to borrow from a bank unless your directors are prepared to offer personal guarantees. So we've got 4 factors here. You may well be able to think of more on top of those, and they give you the mnemonic loss. We're now going to move away from this practical discussion to look at the theories of capital structure. And even though these theories don't add a great deal to the points that you would make about the issues to consider in deciding on your gearing, you absolutely need to know them, particularly the Modigliani and Miller theories, for this exam. Just before we start to look at some of the theories of capital structure, it would be interesting just to take a couple of companies and to have a look at what gearing they have. So on the Financial Times website, you can do a quote for companies like Research in Motion. This is the company that produces Blackberries, and it's a relatively young, high-tech company. So we would, in our notes, suggest that it's early in its life cycle, a high level of fixed costs with unstable revenue. So we would expect it to have low levels of debt. And if we scroll down, we can look at the balance sheet for Research in Motion. Research in Motion 2011, we've got over 10 billion of assets, and if we look at the debt that is used in 2011, it's nothing. And it's been nothing for a number of years. Research in Motion uses little or no debt in its capital structure for exactly the practical reason